Welcome back. In Part 1, we exposed the Federal Reserve's secret history, how it was created on Jekyll Island by the world's richest bankers, how it's destroyed 98% of the dollar's value since 1913, and how every crisis it solves creates a bigger one down the line. We ended with a cliffhanger. The Fed is using a deliberate strategy to consolidate the banking system and engineer the largest wealth transfer in history. Now, in Part 2, I'm going to show you exactly how they're doing it. You're about to learn the precise financial mechanisms behind the 2026 collapse, the inverted yield curve, the bond market time bomb, the liquidity drain, and the cascading bank failures that are already in motion. This is the deep dive, the part they don't want you to understand. Because once you see the mechanics, you can't unsee them. And you'll never trust the system the same way again.
Let's break down the exact mechanism the Federal Reserve is using to orchestrate what I'm calling the 2026 collapse, and why it's irreversible at this point. The inverted yield curve and the bond market time bomb. In a normal economy, long-term bonds pay higher interest rates than short-term bonds. Why? Because lenders demand more return for tying up their money for 10 or 30 years versus 3 months. But right now, the yield curve is inverted. Short-term treasury bonds are paying higher rates than long-term bonds. This has happened before every major recession in the last 50 years. It's not a coincidence, it's a mathematical signal that the market expects economic contraction. Here's why that matters. The Federal Reserve holds $4.6 trillion in treasury bonds with an average duration of 6 to 8 years. They bought those bonds when interest rates were near zero. Now that rates are at 5%, those bonds are worth significantly less. How much less? Estimates suggest the Fed is sitting on unrealized losses exceeding $1.3 trillion. If any private bank had losses like that, regulators would shut them down immediately. But the Fed operates under different rules. They simply don't report it as a loss. They wait, they hold, and they hope rates come down before they're forced to sell. But what if rates don't come down? The regional banking crisis you didn't hear about. In March 2023, Silicon Valley Bank collapsed in 48 hours. It was the second largest bank failure in U.S. history. The cause? They held long-term bonds that lost value when rates spiked. When depositors tried to withdraw their money, the bank couldn't sell the bonds without realizing massive losses. Sound familiar? 3 days later, Signature Bank failed, then First Republic. The contagion was spreading. The Fed's response? They created a new emergency lending facility called the Bank Term Funding Program, BTFP, which allowed banks to borrow against their bonds at par value, meaning the Fed pretended the bonds hadn't lost value. This is moral hazard on steroids. The Fed literally created a bailout program that rewarded banks for the same reckless behavior that caused the problem. And it worked for about 6 months. But the BTFP expired in March 2024, and now over 60% of U.S. banks are holding underwater bond portfolios. According to FDIC data, U.S. banks are sitting on over $650 billion in unrealized losses as of Q4 2024. The fuse is lit. The reverse repo drain and the liquidity crisis. Now let's talk about liquidity, the blood flood of the financial system. The reverse repo facility, RRP, is a tool the Fed uses to manage short-term interest rates. Banks and money market funds deposit cash at the Fed overnight and receive Treasury securities as collateral. It's essentially a safe parking spot for excess cash. During the pandemic, when the Fed was printing trillions, the RRP ballooned to $2.5 trillion. All that cash was sloshing around the system with nowhere to go. But as the Fed raised rates and stopped printing, that cash started draining fast. By January 2025, the RRP had fallen to under $150 billion. That's $2.35 trillion in liquidity removed from the system in less than 24 months. Why does this matter? Because when liquidity dries up, asset prices fall. Stocks, bonds, real estate, crypto, everything that's been inflated by cheap money starts to deflate. And when asset prices fall, the collateral backing trillions of dollars in loans loses value. That triggers margin calls, forced selling, cascading liquidations. It's a death spiral. And the Fed knows it. The Fed's impossible choice. Here's the trap the Federal Reserve is in. If they cut interest rates, inflation resurges. The bond market revolts. The dollar crashes. Foreigners dump U.S. treasuries. The cost of servicing $35 trillion in debt becomes unsustainable. If they keep rates high, the banking system cracks. Regional banks fail. Credit freezes. Unemployment spikes. The real economy collapses. There is no good option. Both roads lead to crisis. And this is where the conspiracy gets real. The engineered consolidation. In 2008, the financial crisis resulted in the elimination of Bear Stearns, Lehman Brothers, Washington Mutual, Wachovia, Countrywide, and dozens of smaller banks. Who bought them? JP Morgan, Bank of America, Wells Fargo. The big banks got bigger. Concentration increased. And the phrase "too big to fail" became policy. Now it's happening again, but faster and more deliberately. Since 2020, over 220 community and regional banks have been absorbed by larger institutions. The Fed's rate hikes have made it impossible for smaller banks to compete. They can't afford the capital requirements. They can't absorb the bond losses. They can't survive the liquidity drain. So they sell, or they fail, and the big banks pick up the pieces. This is not a free market. This is orchestrated consolidation. And the model they're following comes from a man named Hyman Minsky, an economist who described the inevitable cycle of financial instability in capitalist systems. Minsky argued that stability breeds instability. When times are good, banks take more risks, leverage increases, speculation rises, until the system becomes so fragile that even a small shock causes collapse. The Fed knows this. They've studied Minsky, and rather than prevent the cycle, they're using it. They inflated the bubble with zero rates and QE. Now they're popping it with rate hikes and QT. And when it implodes, they'll step in with another rescue, but only for the institutions they choose. The 2026 trigger event. So what happens in 2026? Here's the timeline based on current data. Q2 2025. Reverse repo facility hits zero. Liquidity crisis intensifies. Q3 2025. Credit spreads widen. Corporate debt defaults begin to rise. Q4 2025. Housing market rollover accelerates as adjustable rate mortgages reset at higher rates. Q1 2026. A major financial institution, likely a regional bank or insurance company, fails to meet collateral obligations. Q2 2026. Contagion spreads. The Fed is forced to choose bailout or collapse. They'll choose bailout. But this time, it won't be a secret $7 trillion in loans. It will be overt, massive, and inflationary. They'll restart QE. They'll cut rates to zero. They'll backstop everything. And the dollar will lose its reserve currency status within 18 months. The Great Wealth Transfer. Here's the final brutal truth. This crisis will not hurt everyone equally. If you hold cash, you'll be destroyed by inflation. If you own a home with a fixed-rate mortgage, you might survive, but property taxes and insurance will crush you. If you own stocks in leveraged companies, you'll watch your portfolio evaporate. But if you're holding hard assets, gold, Bitcoin, productive land, energy infrastructure, you'll watch your wealth multiply as the fiat system implodes. This is the largest wealth transfer in history, and it's not accidental. The Federal Reserve, the Treasury, and the largest banks have spent the last 15 years positioning themselves. They know what's coming. They've wargamed it. They've stress-tested it. And they've made sure that when the system resets, they'll be holding the assets that matter. You won't, unless you understand the game and get out of their casino before the lights go out.
So here we are. The Federal Reserve, an unelected, private institution with zero accountability, has activated the final stage of a debt-based monetary system that was always designed to collapse. They've engineered the conditions. They've removed the liquidity. They've inverted the curve. And now they're waiting for the dominoes to fall. And when they do, they'll offer the same solution they always do. More centralization, more control, more power for the institutions that caused the crisis in the first place. Maybe it's a central bank digital currency. Maybe it's a new Bretton Woods. Maybe it's a global debt jubilee with conditions. But whatever form it takes, the outcome is the same. You will own less, and they will own more. This isn't pessimism, it's pattern recognition. The dates change, the names change, the mechanisms get more complex, but the game remains the same. The difference now is speed. In 1929, it took years for the consequences to unfold. In 2008, it took months. In 2026, it will take weeks. Because the system is global, the leverage is exponential, and the distortions are bigger than any central bank can control. So the question isn't whether the collapse is coming. The question is whether you're prepared, mentally, financially, and emotionally, for what comes next. Because denial is expensive, and borrowed time always runs out. If this video challenged something you thought you knew, share it. Send it to someone who still thinks the Federal Reserve exists to protect them. Drop a comment with your biggest takeaway. And if you're ready to keep learning the mechanisms they hope you'll ignore, subscribe and turn on notifications. Because the next 18 months will redefine wealth, power, and survival in America. Are we wiser now, or just walking the same path in better suits? The clock is ticking.